Okay, so we're up to the last chapter, chapter 14. And this is we're going to talk about tax consequences of home ownership. You may remember back in chapter 1, we talked about how the government will do things to encourage certain behaviours. And so home ownership is one of those areas that they want to encourage people to own their own home. So there are quite a number of tax advantages because home ownership obviously is of a personal nature. And when it's of a personal nature, you normally don't get a tax deduction. So let's start going into the chapter. So what do we mean by a dwelling? Well, a dwelling can mean a home, condominium, mobile home, boat. It means it's something that has a bathroom. So if it's a boat and doesn't have a bathroom, it's not going to qualify as a dwelling. But a boat that's large enough to have its own bathroom is going to, or toilet I should say, is going to qualify as a dwelling. And there's a number of things a dwelling can be used for. It can be used as a principal place of residence, can be used as a pure rental, or it could be a combination of the two. And we're going to go through the tax consequences of all those different scenarios. So first of all, we've got to determine, is it a residence or a non-residence? So it's a residence if personal use days are more than 14 days during the year or 10% of the number of rental days during the year. Otherwise, it's a non-residence, and so the tax treatment's very different. This tells you what includes personal use days and what is rental days. Residence is principal, and it can change each year. One year my residence could perhaps be in San Diego, another year my residence could be in Phoenix or Scottsdale, Arizona, and I get to determine that year on year. Okay, so what are the advantages? Well, I get my home mortgage interest as a Schedule A deduction if it's a principal residence or a residence not my principal residence. So I can claim two different residences from my home mortgage interest deduction. My real property taxes, I'm going to get a Schedule A deduction for my principal residence on my residence not my principal residence and on a non-residence. And then anything associated with the rental use, I can get deductions for unless the rental is 14 days or less. And then when I go to exclude, when I go to sell the home, I get to exclude part of that gain potentially, depending on ownership and use tests being met. So there are, as well as tax considerations to home ownership, there are non-tax considerations. And one of those is it's a large investment. And if the value goes down and the mortgage remains the same, you could be underwater. Think about 2008, 2009. There's also maintenance costs. But as a general rule, the fact that interest on your mortgage is deductible and rent is not a deduction, well, except in California, there's a renter's credit of like $60. But other than that, generally from a tax viewpoint, you can itemize your deductions for your interest on your mortgage. Your rent you can't claim a deduction for because it's personal. And if I sell my personal residence, then it's a personal use asset. So if there's a loss, I don't get to claim that as a capital loss. But if it's a gain, I'm going to have to pay tax on it. But this is one of those times when it's included in gross income unless there's an exemption or deferral. And this is an example when there could be an exemption. That's going to be the $500,000 married filing joint, $250,000 if other filing status. Now, generally, any of the gain in excess of the exclusion amounts are going to be long-term capital gain, subject to the preferential rates, unless, of course, your holding period is less than 12 months, and that's generally going to be because you relocated for a job and you met those hardship requirements. But as a general rule, any gain in excess of the exemption amount is going to be long-term capital gain. So there's two tests that have to be met. One is an ownership test. So you have to have owned the property for a total of 2 or more years during the 5-year period on the date of the sale. So in other words, you look at the date of the sale and go back 5 years. And in that 5-year period, you need to have owned the property for at least 2 years. If you're married, either spouse can satisfy that requirement. And then there's a use test. And that means that you've used it as your principal residence for at least 2 years out of 5, ending on the date of the sale. So date of sale, go back 5 years, and you have to have used it for 2 out of those last 5 years as your principal residence. And if you're married, both of you have to satisfy that requirement of the 2-year period. So I've got an example here. Tyler and Jasmine are married, and Jasmine moved into Tyler's home located in Denver. Tyler had purchased the home 2 years before the marriage, and after the marriage, the couple lived in the home together as their principal residence, and they lived there for 3 years before selling the home to move to Chicago. So Tyler was the sole legal owner, but they both resided in it as their principal residence. So would they be entitled to the $500,000 exclusion? Remember, $500,000 married filing joint. So ownership. Well, let's go for use test first. So did they use it for 2 out of the last 5 years? Both of them required to? Yes, they did. Did one of them own it for that 2 out of the 5-year period? Yes, Tyler did. So they're going to be able to meet that exclusion. So there are exceptions to that general exclusion. Remember I said there are rules and then there are exceptions to the rule. And this is one of the exceptions to the exclusion of the $500,000 to $50,000. If there is some non-qualified use during that period, then the exclusion there's going to be pro rata, and the textbook has some great examples of when that applies. And then there's hardship examples. You have to sell before you can meet the exclusion period, so that 2 years. So things like moving for your job. So you don't get the full exclusion. What happens is for the months you met it, that goes into the numerator, divided by the denominator of the 2 years, multiplied by the exclusion amount. So let's do an example. Example being the Jeffersons moved from Denver and they purchased a home in Chicago. And they moved into that home July 1 of year 0. In January of year 1, Tyler accepted a work opportunity with a different employer located in Miami, more than 50 miles away. So on February 1 of year 1, they sold their home for $525,000 and relocated to Miami. So they had a $150,000 gain, which obviously is far less than $500,000. However, they don't meet 2 out of the last 5 years of use and ownership. So how's that gain going to be taxed? So what we have is that we have 7 qualifying months that they actually lived in the home and owned it, used it as their principal resident and lived in it and owned it. 7 months is the numerator, divided by the 2 years, the 24 months is the denominator, multiplied by the exclusion amount. So the exclusion amount they're allowed is $145,833. And when you offset that against the $150,000, they're going to have a gain of $4,167. Now, they owned the property for less than 12 months. So therefore, it's going to be short-term capital gain, and that $4,000 will be taxed at ordinary tax rates. Home mortgage interest. So when you acquire a property and you take out a mortgage on the property at the time of the acquisition, that's called acquisition indebtedness. That's the debt that was used to acquire or construct or substantially improve the residence. When you have that, that's your acquisition indebtedness amount. Now, interest on that amount up to $1 million is allowed as a deduction. However, with our tax reform legislation, that was reduced to $750,000. So for any purchases after December 15th or any debt after December 15th, 2017, you're only allowed interest on $750,000. We also used to have another $100,000 of home equity interest that you could take a deduction for. That was repealed in the tax reform legislation. So in 2018, you don't get any interest on home equity debt. So it's either $1 million if you acquired the debt before December 16, 2017. The $1 million is the principal amount, not the interest. It's the interest on that amount that's deductible. And remember, the loan has to be secured over the home. When you buy a home, you can actually reduce the interest rate by purchasing points. And so you're allowed points as a deduction, depending on whether you pay the points at the time of the acquisition or with refinancing. If it's the time of the acquisition, then you can immediately expense the points. If it's at time of refinancing, you have to amortize the points over the term of the loan. So let's say that on January 1, Tyler and Jasmine bought a $300,000 home, financing the purchase price over 30 years, and they paid 2 points to get a lower interest rate. How much of the points can they deduct in the current year? And how much if they paid 2 points to refinance? So we'd be able to get all of the points if it was the acquisition indebtedness, or if it's refinance, it'd have to be over the term of the 30 years. Real property taxes. So real property taxes form part of your tax deduction on Schedule A. Again, that's part personal expense, but the tax code permits you to claim a deduction. However, with the tax reform legislation, your deduction for taxes is limited to $10,000. So that's your state income taxes and your real property taxes. So in a state like California, you can quickly hit the maximum. So this is showing you if Tyler and Jasmine bought a new house on September 30th and the property tax bill for 2018 is $7,000 and they pay the full amount, cash basis taxpayers, would they get the full $7,000? Well, no, they're not going to. They're only going to get the pro rata share for the period they owned the house. And that would be through escrow, there would have been an adjustment. So they will get the 3 months, because October, November, December, of the $7,000, and the seller will get the other 9 months. So rental use of a home. So there are 3 types of classifications. So residents with minimal rental use. Now, that says for a second home, but a lot of people during events like Super Bowl will rent out their home, and as long as it's they haven't rented out their home for more than 14 days, all of that rental income is exempt. Because remember, everything's included in gross income unless there's an exemption or a deferral. So rental income on your place for periods during the year of less than 15 days, you don't have to pay any tax on that rental income. Correspondingly, you don't get any deductions, of course, but one hopes that the rental income far exceeds the deductions. And if you live in a place where Super Bowl's being held or a golf tournament or something where people are coming to town, you can make some good money if you have a really nice house. Now, if you have significant rental use, so that means you rent the home for 15 or more days, then you're going to have to prorata the expenses against the rental income. And if it's a non-residence, you're going to offset the expenses against the income. So we spoke about that. If you rent it for 14 days or less, no income being included, but no expenses being deducted. Now, if you rent the home for 15 days or more, the personal use is greater of 15 days or more than 10% of the fair market value of the rented days. You're going to include the gross income and allocate expenses. Now, we have what we call Tier 1 expenses, Tier 2 and Tier 3 expenses in this situation. What happens is the Tier 3 expense depreciation can only be claimed if there's sufficient income. Tier 2 expenses, which is all your expenses other than the expenses that are in Tier 1, and those Tier 2 expenses can only be claimed to the extent you have sufficient income. Tier 1 expenses, which are the ones you calculate first, is for the expenses that are directly related to the rental, so things like advertising, interest, and taxes. So they're your Tier 1 expenses. Then everything else except for depreciation is Tier 2, and depreciation is Tier 3. So let's go have a look at if we're doing the tiered expenses. And remember, we have 2 different methods for calculating our Tier 1 expenses. We can either use the IRS method, where the denominator is the number of days that it was available for personal and rental use, or the tax court method, which for Tier 1, the denominator is 365 days. Everything else we use that IRS method. So you can see here with this example that the IRS method results in far more expenses going against Tier 1, which means there's less Tier 2 expenses and then less Tier 3. Now, in this example, there's sufficient income to offset, but if you had less income, then you probably want to use the tax court method, because that means you've got more availability to offset the other expenses, including depreciation. However, with the limitation on the real estate taxes, you might want to use the IRS method because there's going to be less real estate taxes more real estate taxes going against the rental income, so less on Schedule A. If you might be limited in the amount you can claim on Schedule A because you've got state income taxes, you may want to use the IRS method. So before we had that $10,000 cap, generally most people would want to use the tax court method, because for interest and real estate taxes, what you don't claim on the Schedule E against the rental income, you're going to claim on Schedule A. That's the balance. Now, the non-residence, which is the rental properties only used for rental purposes, the taxpayer includes all income and deducts all rental expenses. But if there's even 1 day of personal use, then you're going to have to go to the previous method. All right, so we have an example here that they didn't use the home for personal purposes. They received $37,500 in gross rental income and incurred $40,439 of expenses. So you can already see there's going to be a loss, right? So we're not going to consider passive activity loss limitations. What happens? They're going to generate a loss of $12,939. So they can take that loss unless it's passive. Now they're going to be considered passive unless the taxpayer materially participates. And remember in Chapter 7, it sets out the requirements for what determines whether a taxpayer is materially participating in an activity. But let's say that they are participating in the activity, then they can actually claim up to $25,000 of rental real estate losses, provided, and claim them as ordinary, provided their AGI does not exceed $100,000. And if it does exceed $100,000, there's a 50% reduction in that $25,000 loss up to $150,000. So under $100,000, you can claim rental real estate losses up to $25,000. I mean, if you only got $15,000, you only claim $15,000, even though you're allowed to claim up to $25,000. And if your AGI is over $150,000, then you can't claim any of the losses. But those losses can be claimed in the future when you have sufficient income or when you dispose of the property. Think back to Chapter 7. Okay. And that just goes through the phase out. Home office deductions. So you can have a home office deduction, and that means that you're using the home office. Either it's your principal place of business or you meet clients and patients there. There's very strict rules, and the IRS does audit this area because there's a lot of abuse that can occur in this area. You can only claim it if you're self-employed, and there's two methods. There's a simplified method or the actual expense method. Use the actual expense, you have to allocate between personal and business use. You got your direct expenses, so things that would directly relate to that home office, say the furniture, versus indirect, which would be a sharing of the utilities. And the indirect expenses will be allocated based on square footage. And you're limited to the amount of your Schedule C income. So in other words, we can't take deductions that are going to result in a loss for your Schedule C business income. And we've also got the simplified method where you can deduct the square footage up to 300 square feet times $5. So that's a maximum deduction of $1,500. Of course, if your home office is only 100 square feet, then you'd only be able to claim 500 maximum. Again, limited to Schedule C, and you don't get to carry over the excess expenses like you do if you use the actual expense method. Okay, so for our 3 questions for this presentation, the first question is, can a boat qualify as a principal place of residence? And of course the answer is yes, provided it has a toilet, but the answer is going to be yes. Secondly, are points allowed as a deduction? And the answer is going to be yes, provided it's with the original debt. You pay points when you acquire the home. And the third one's going to be is what tier does depreciation fall into when we're looking at the expense categories for the rental, and it's going to be Tier 3. Thank you very much. Good luck.